Boom, 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 boom. I think I actually found a stock that I'm interested in. Boom, 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 boom. Woo! Welcome back to Strong Man Personal Finance, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. Go buy it, baby. And we're going to check out this stock called Inmode, my steaming commode. I cut myself up. So, I'm looking at this stock right here, and I've heard about it multiple times. Jeremy's dad likes this stock. Jeremy doesn't like it because it's profitable. And I saw a comment today to check out this stock, because apparently all I do is I hate on stocks, which is true. I don't buy stocks unless I can get a 15% return. 15%, ladies and gentlemen. And if I'm not going to get that, I'm just going to buy an index fund. Okay. So, what is Inmode, my commode? Well, let's open up this investor presentation, which it actually takes a while to load. It's like this weird format where you, like, it's not like a PowerPoint slide. You'll see in a second, but I have to, like, download it, and then it freaking pops up, and then we can go through it. But basically, it's a medical device company. And according to their presentation, they're basically a disruptor in the medical device field. They focus on plastic surgery, making people look pretty and beautiful. And there's a big market for that because I want to be hot. Yeah. So here's Inmode, my steaming commode. Okay. So what are they? Who are we? We're a leading global provider of innovative, minimally invasive aesthetic and wellness solutions with strong brand recognition. Now, a lot of this medical crap I don't understand, but what I like about this company is they're growing their revenue, number one, and they're profitable. So you look here, and they have Q1 2022 by the numbers. They got revenue by revenue, okay? Gross margin, 83%. That's pretty freaking good. Net income, it's positive, $34 million. 34 on 85 is like, what, 45% profit margin? That's pretty freaking good. On top of that, it's internationally diversified. Okay, they're selling to customers in 77 countries. That's good. You don't want to just be focused in one country, including in your stock portfolio. So there's a lot going for this company. And of course, Mike Stathis would not be happy with this, as it's headquartered in Israel. But here's the management team, okay? You got people that are, have 20, 15, 20 years of experience. But then again, does that matter sometimes? I mean, look at Tattooed Chef. So you can see they have a bunch of stuff everywhere, okay? They have 157 people selling in the United States and Canada. They have subsidiaries in Europe. They're headquartered in Israel. And they even have a presence in Asia. So basically anywhere where there's high incomes and it's in the developed world, you're potentially going to see a presence. You're not going to find this in like some poor country in sub-Saharan Africa because they're a high-end company that provides medical devices. And you might even find it there. If there's some, rich families that live there. So basically they're talking about the evolving aesthetics market because everybody wants to look young and beautiful. And instead of going to the gym and running and dieting, I can just get surgery and my husband will pay for it. Yeah, okay. But it's a huge market because people want the easy way. They just want to pay a doctor and they can like scan their skin or whatever they do. And bada bing, bada boom, you're prettier. So here they are. They're saying this is a paradigm shift, okay? So let's see what they do, okay? Now, like I said, it's a bunch of medical crap. Here they have radio frequency assisted lipolysis, RFAL, and they got a little laser going in the skin. And it's surgical face and body contouring without scars. The holy grail of plastic surgery. So we can see, look at this. Is this going to play? Hold on. Could have just gone to the gym, buddy.
But face tight does
So here's Missy. You can see how her face looks prettier. Okay. Okay, you got some grannies. They're bending over. Look at her stomach's flatter. And this guy's back's tighter. This woman's flab on the bottom right's gone. I mean, okay, they're making people look prettier. Deep subdermal fractional RF. Okay, they're shooting lasers into your skin. Sharks with laser beams on their heads. Okay. So, yeah, look at this. Neck and subdermal fractional RF. I don't know what that freaking means. But if these results are legit, I mean, that's pretty good. Okay, people will pay for this 100%. Especially if you're older, okay? You start to get 35, like old like me, I'm 32. You know, your skin starts sagging. You still want to be hot. You think back to your glory days when you go to the beach and show off your abs and your smooth skin. And men would look at you and, oh yeah, she's so hot. And if you get this surgery, you'll be just like that when you're 70 years old. Now, I don't know what this is, but at least we can see this girl's butt, so that's nice. But apparently they're, I don't know, vibrating her abs. See, like, I'm looking at this. Non-invasive cellulite treatment. I mean, I don't see the difference. I see she's like a blotch of bluish purple blue on her. Green. I mean, okay. I guess it treats cellulite. So they got a lot of cool stuff. Now, this is my favorite. Can you imagine wearing this around town?
Hey, hello, I am doing facial remodeling. Welcome to the future.
So apparently they somehow remodel your face by putting this ridiculous device on it. So I don't know how it works, okay? Look at this handsome fella. It looks like he just shaved. You know what I'm saying? Like he got his facial hair. Looks like his chin's a little bit stronger. He's got more of a jawline. He's pretty hot now, you know what I'm saying? So they do a lot of cool stuff. I mean, look at this looks like an old Spanish lady. Pretty cool. So let's go look at the financials, because I know it's all about the future and exciting, but the financials are what matters. And you can see that Inmode had a massive freaking run up. Starting in, you guessed it, March 2020. And it went all the way to $94.74. And now it's back down to $26.91. So now I'm interested, okay? Let's go look at the press releases. So they had a press release where they announced their first quarter 2020 results. So once again, they're still profitable. And they have revenue growth of 31%. However, forward guidance is going to be a little bit lower. As we can see, their revenue going forward is going to be 16%. So their revenue growth is massively slowing down. Why? I'm not sure, but when you do your modeling, you don't want to plot in 30% revenue growth, because then you'll get an insane valuation for this company. So let's go look at some of the highlights. So revenue increased by 31%. Revenue. They had GAAP net income, earnings per share of 36 compared to 31. So let's see how fast or how much higher earnings per share increased. So earnings increased by 16%. That's good. You want earnings growth. 2022 started off strongly despite the uncertainty in global markets, blah, 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 blah. We continue to add new features, blah, 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 blah. Okay? Now, they also gave forward guidance for the full year of 2022. And that's where the 16% growth comes in. So they're going to have full year revenues of between $415 and $425. So if we go look at annual revenues, in 2021, they had $357 million of revenue. So if you go on the low end and you say, okay, they're going to have $415 million, divide that by 357, 16% revenue growth. On the high end, which I'm not going to use in my analysis, they could have 425. So it's 425 divided by 357. So low end, 16% revenue growth, hopefully. High end, 19%. That's still pretty impressive. Gross margins between 84 and 86%. Ooh. Non-GAAP income from operations. Okay, I don't like that. So let's go look at their financials a little bit more. So going through this, we can see they've had some explosive growth. In 2017, they had $53 million of revenue. And 5 years later, roughly, $357 million of revenue. Very, very impressive growth. I can see why this stock took off. They have selling general administrative expenses. I wonder how much share-based compensation's in there. R&D, they're really not spending that much on R&D. That's kind of surprising. They're spending 9.53, 3% of their revenue in R&D. Okay. I guess they already have products and they're just sticking with them. Let's see, shares outstanding. So they have had increases in shares, but you can see year over year, it's starting to slow down. They issued 17%, 8%, 10%, 2%. And they actually announced a share buyback program. Okay, earnings growth. Look at that earnings growth. The earnings are growing faster than the freaking revenue. That's pretty freaking good. Gross margins, pretty consistent. 85, 87, 85, 84, 83. Profit margin, 46, 36, 39, 22, 16. So their profit is freaking skyrocketing. Now, I can see in 2021, they had a profit margin of 46%. I don't know if that's natural growth or if they were somehow a beneficiary of the pandemic. I don't know. I don't think so. But we can use more conservative profit growth. Look at free cash flow. 48% free cash flow margin, 38, 39, 36. Wow. This is a pretty profitable company. It's almost too good to be true. We go look at their balance sheet. They have $415 million of cash or cash short-term investments, which they could probably liquidate. And let's see their current liabilities. Very strong financial position. So their short-term debts are $51 million, and their current assets, which are very liquid, are $415 million. They're not going out of debt. Long-term debt, they have no freaking debt. I mean, look at that. $3 million of long-term debt. Okay, well, $10 million, $11 million. Still not a lot. Let's look at their cash flow. Operating cash flow, massively increasing. Now, we can see they have share-based compensation, but they are announcing a share buyback program, and it's not egregious, okay? And you can see they still have positive net income and positive operating cash flow. That's good, okay? It's unlike Dropbox. They had freaking loss and a massive operating cash flow because of share-based compensation. So operating cash flow is growing. Let's see. Capital expenditures, very low. This is a very efficient company. Look at this. Share reissuance, they're buying back shares. It's pretty good. I mean, wow. Free cash flow per share freaking exploding. There's a lot to like about this company. PE 13. Now, this is the first thing that stops me. This company's growing. It's doing great. It's got high profitability. Why is there PE 13? That's very, very weird to me. Okay, there's something potentially going on underneath the surface that I am not seeing right now, but that's really weird. So before you buy this company, maybe you want to speculate in it, but you need to look and see, why is there PE 13? That's crazy. That's crazy. For a company like this is like rock solid. Price to free cash flow, 12. Cheap as crap. Let's see. Debt, they have no freaking debt. Massively high current ratio. Return on invested capital, 52, 55, 46. At this point, I'm just like, why? Why is this so cheap? Debt to free, they have nothing. Like, this is like the perfect company. What's going on here? So I'm going to throw some of these numbers into my calculator, and we're going to see. I've already like pre-looked at it a little bit, but I'm going to give you kind of like potentially what I would do. So I got their trailing 12-month revenue in here. I got their shares outstanding. It's roughly 86 million. They're going to be doing some buybacks. Discount rate, I want a 15% return. Revenue growth assumption over the next 5 years, I'm going to say 10% to be super conservative, because you can see they had a massive slowdown. Don't know what's causing it, but it is. Let's do profit margin. Let's see, 40. Let's see, quarterly. Let's look at the quarterly profit margins. 35, 47, 46, 40, 48, 40. I'll go with 40. I think that's reasonable. Free cash flow margin. Let's go back. 36, 47, 53, 53. We'll go with 45. I think I already had that in there. Okay? And just to be super conservative, a PE ratio of 15. Now you look at this. For a 15% return, this stock is already a buy. Look at that. $30 for a 15% return based on GAAP. $33 based on the free cash flow. Now, according to this analysis, the market cap in 5 years would be $4 billion. Is that crazy? No, I don't think so. Let's see. What is their market cap right now? So basically it would be a 2x. I mean, their market cap was already $5 billion. I mean, that was a massive run up. So, I mean, it's possible. A company growing this fast, they could double their market cap, especially if there's an exuberant market. Maybe. So you look at it, on the surface, it's a screaming buy. But here's where you need to do more research, because I'm very concerned that this company that has such pristine financials has a PE ratio of 13. Why? What am I missing? I don't know. Everything looked golden to me. So I'm going to do more research into this company and really understand what's going on beneath the surface. Because, I mean, if I were to model this out, I'd say, okay, maybe they have a PE of 20 based on their growth rates. Screaming buy. But that doesn't mean go buy it. You need to research, because one thing I've kind of learned in the market is if a company's cheap, it's cheap for a reason. So that's my thoughts. It looks like it's a good deal. I don't know. I'm not buying it yet. I'm going to do more research. And that's kind of it. Hope you enjoyed the video. Have a wonderful night. Cheers.